Hi, everybody. This is the Beats Roundtable. I am Herb Greenberg. It is Wednesday, April 10th. Inflation is up, interest rates are up, stocks are down, and bond investors, they're getting smoked. As always, our group is here to talk investment ideas and what they are working on and anything else we decide to talk about later in the show. But with me today is Jeff Mackey, Mr. Robert Marson, Benjamin Bry, and Bernard Barchet. Jeffrey, what's on your platter today?
Just a absolute slobber knocking in the entire consumer space. I mean, inflation comes in hot, and my entire basket of consumer related stocks is just a bunch of defenseless little kitties out there. How are you going to argue for them? It's a tough day, but that makes it also the opportunity. So I've got two names that I'm looking at in particular. One has been just destroyed over the last month or so, and that's Elf Cosmetics. And they didn't really do anything wrong. It's just a high price stock that came into the last month. They reported great earnings, but they weren't great enough, which kind of defines where we are in the marketplace right now. Anything high multiple is going to be defenseless. But what I'm looking for to select and kind of separate the wheat from the chaff on these sell-offs are companies that are going to continue to grow and that are being penalized just because of the space they're in. That brings me to Elf. Elf just has been destroyed since earnings. It was their guidance that made people a little suspect. I was fine with that. B is where the opportunity came in. That's where Ulta, they warned on Q1 for the second time in like 3 weeks. They blame the industry. I'm blaming Ulta for not having a better handle on their business. You don't warn during your conference call, and then 3 weeks later at JP Morgan, for some reason, Elf has been beaten more than Ulta. I think Elf has taken share. So I've got two ways to play it. One, I want to nibble away at Elf. Again, it's going to be a problem until you get to a second half growth story, but you got to buy these names on the dip. If you're waiting for something like this to get cheap, well, by the time it gets cheap, it's going to be in an Ulta situation where it's already kind of run its course and in a secular decline. I don't think Elf is there yet. They're taking share according to the Piper Consumer Survey, one of the few surveys that's actually worth listening to. And where they're doing it is in my second name, which is Target. That is a forgotten darling. It's been left for dead. They've got a lot of different ways to win. They're telling basically everyone, consumers, they've got so many different ways to win, and they're doing it through brands like Elf. Elf is taking share in Target. They told us so themselves. It's one of their number one partners, but that also tells me that you have income levels all over the map that are going back to Target. They're revisiting again. This store lost its way. It's been dead money for the last 3-4 years. I want to be adding to that. It's got a 17 multiple, about 16 and a half forward. So the growth rate isn't great, but the stock is trading where it was when revenues were 40% lower. Can Target kind of figure out a way to get those margins back and start making money again? I believe they can. I think there's plenty of low-hanging fruit. That's a name I think you plug and chug on that. I want to be long them more aggressively now. Elf, you nibble away. You just like kind of pick away at it. By the time we get to the Christmas elves, that stock's going to be higher. Target continues to work higher from here, closing that valuation and just sort of investor taste gap that we've seen grow between Target and Costco and Walmart over the last few years. The latter two have been sort of darlings, at least to the extent discount stores become darlings, whereas Target's been forgotten. And I think that's an oversight. I think the market will correct that, and Target just has more room to run. So that's kind of my double pain basket. I don't expect either of these things to be great this week, but I do expect them to be higher by the end of the year.
Well, Jeff, when anyone hears, certainly when I hear buy on the dip, get a little nervous because that is a little bit of, we all know what that sometimes means. And I don't know, are we talking traders or are we talking investors here when we talk these
We're
days?
talking investors here, Herb. If you're trading this and CPI is coming in hot, you're just setting yourself up for a beatdown. I don't know if anyone ever really believed in this 5 rate cuts in 2024 scenario, but really that was kind of introduced months ago, and people have been talking crap about it the entire time. How many times are we going to sell off on the idea that Jay Powell is going to be data driven? Well, I don't know. The guy says that every time he speaks. The data, it doesn't really support 9,000 rate cuts, so that's probably not going to happen. So we can beat these stocks over and over again, but that's an exogenous variable as opposed to a dip like, say, an Ulta. If it's company specific, take me the hell away from there. That's kind of dip buying on hope. What I'm doing is buying a dip based on just the collective wisdom, sort of chucking babies out with bathwater. As long as it's not company specific, as long as these companies fundamentally are sticking to their knitting, not spending all their time complaining about inflation, not spending all their time like Alta did talking about this huge slowdown that they're seeing all industry wide. while all the other companies in the industry are just kind of shrugging. Not all dips are created equal, and you got to look at what the actual catalysts are and how specific they are to your companies.
Well, the other question here, though, on these two companies and on others is, you've owned these things, so you're adding to positions. What about initiating? What about initiating positions at these levels?
I would look for right now to initiate in ELF. In ELF, I have not been as long as I would like to be because it's just the kind of thing you just sit there saying, boy, that looks expensive. And I've sat there saying, boy, that looks expensive for about a triple now. So this is where I want to start building this. Target was left for dead. I'm not in the business of falling in love with stuff forever and riding it down to zero. So I'm happier on that name to have missed it at 125, 130. And if I wasn't long already, I'd be adding to the position here. I'm not doing it through calls. I'm not levering up. And again, the discretion is the better part of valor. I'm watching the retail kind of basically pick an ETF, pick any way you want to measure these specialty retailers or the general group as a whole. They've had a nice 6 months and a really crappy last month and a half. And so I think we're just pulling back into a more rational space with a lot of these names. And this is where you want to start adding. It's ultimately, we're always investors. The best way to make money is to buy something and never have to sell it. So right now is kind of when I want to be building positions. And from, you can call it a trade, you can call it a long-term investment. I'm in the business of making money and trying to not take any transactions that cause me a tax bill whenever I can.
All right. Hey, thanks. Good info. Robert Marson, turning to you. You were telling us about a company a while back. What was that? It was
Intest.
All right. So is this a victory lap for you? What are you?
No, it's only up 10% since then, and the news is far better than I imagined. I'm actually recommending this stock here today that I hope will go down for non-fundamental reasons. So it's a $12 stock, 12.5 today. It's $150 million market cap, which is a small cap, but it's a good thing to buy.
No, it's a nano cap.
Nano cap, yes. That $150 million market cap is under right now what we estimate to be the minimum requirement to be in the Russell 2000. So they're going to get the boot from the Russell 2000. That's good for 500,000 shares probably on the sell side. With any, it trades, less than 100,000 shares a day. With any luck in a bad market, once this becomes obvious by the end of this month, which is the cutoff date, the guesstimate date for the whole procedure happens between now and June, but everybody tends to front run this. So the stock hopefully will get $1 or $2 correction from 12. Now, fundamentally, you don't want to own this for next quarter anyway. It's not a trade, it's an investment. Okay, the reason is they have an inventory correction they're digesting with their customers. So their numbers are pretty poor. They're making 15 cents a quarter right now. The estimate, according to my forecast for this year and next, is they get that earnings run rate up to 30 cents a quarter by December, and they do probably $1.25 to $1.50 next year. For a $12 stock, that's an industrial conglomerate. It's in the right areas. It's in semiconductors. It's in reshoring of manufacturing capacity. They make test and measurement equipment. They make process equipment. It's a lovely little debt-free, 15% growing conglomerate that has an opportunity through bolt-on deals to double the business from $150 million this year to $300 million within 2 to 3 years.
What could go wrong?
There's no debt. Capital goods in general are cyclical. So if there is, and they're in a major down cycle in the semiconductor division, it was down 50% year on year last quarter, while the sales were only down about 15%. So it's a cyclical business, and in a recession where people would pull back on CapEx, that would be a concern. That is a concern of mine, but not for at least 2 or 3 years, because they're just in the beginning innings of the build out for analog semiconductors in here as we try to onshore domestic capacity. TI is their biggest customer and is building 3 world-class fabs in the U.S. over the next 5 years. That's their biggest customer.
So you and I often talk, when we talk about these nano caps, we talk about your your lottery tickets. What's your conviction here on this one?
Well, this company has an excellent IP, has been around for 30 years. It's not something that you buy and you're going to lose everything, if it doesn't work. It's not that. It's a solid company with great management team, great balance sheet, great IP. So it's just probably opportunity cost. And in the recession, in the recession, this stock tends to get fairly cheap. It's one-time sales now. I've seen it go to half of sales. That's 50% decline. So if they lose money, and we're in a 2008, 2009 great financial crisis economy, the stock would go to probably mid to high single digits. Now, you don't have to sell it at mid to high to see at the worst time of the economic cycle either. So if you put this away for 2 to 3 years, I believe it's a $20 to $30 stock. I sold the stock last year at 20 and I sold it at 27. So this has been eviscerated as a stock. They say there's no cheap stocks out there anymore. This is 10 times next year's earnings, one-time sales, debt-free, cash on the balance sheet, 15% free cash flow, 10% free cash flow yield. And, it's hard to, so I can't see you losing unless the economy really goes into the tank from here.
This is a true buy on the dipper. It sounds like
yes.
On the big dipper, it's a big buy on the dip.
It's a bigger buy on the big dip, but we don't want to live through that yet. That's for 2028.
Okay. Listen, thanks. I want to bring in Mr. Benjamin Bry here. We're talking about something entirely different, Benjamin. Tell me where we're going this morning.
Well, I was going to talk about gold, but given what's going on, I might just pivot here on the dime and just talk about what's going on with the macro markets, because basically everything that I've been talking about for months just came to a head today. The market has now realized that we're in a stagflationary period. The SOFR curve is off 25 basis points, which, if you don't know the SOFR curve, that's the policy rates, used to be the Eurodollar futures, and that's an enormous move. That's a move that crushes people. Last night, there was a guy who put the all-time biggest trade ever on in the DEES contract, and I don't think he's having as good a morning as I am. So, I think what happened was the CPI came in hot. It's clear inflation's not broken. And now the bond market's selling off. And the most interesting thing that's going on right now that maybe isn't getting as much play is that the BBOC and the BOJ are now in a gigantic chicken fight, where the CNH-JPY, which is the Chinese cross rate, is basically at a point where, because they're both competitors for exports, right? So this is the most important variable kind of to look at. And the yen just broke the 152 level this morning. So the question is, who's gonna do something first? On the one hand, if the BOJ decides to defend the currency, they're going to sell treasuries and exacerbate the bond move to the downside. On the other hand, which I think is going to happen, is the PBOC is going to devalue the RMB, and that could have a lot of deflationary effects to the world. So this is a very important thing that I don't think a lot of Americans are focused on at the moment.
So how are you positioned for this?
I'm short the CNH. I am short the bond market. I'm short the SOFR curve. I've had a TLT risk reversal 109.90 since January. I'm long gold, and I like my values, like random value stocks, special situation stocks. That have nothing to do with this, but I'm like Bob. I like cheap special situation stocks.
So if you're an investor in this market, if you're an investor in this stock market here, what are you saying? So what would you be doing right now? You've been holding on to things. Things have been looking very good. What do you do? Getting a little weak today.
I would take profits. I mean, I don't know what to tell you.
But how many times could we have had that discussion over the past year where things just looked like they were about ready to inflect? I've written about inflection points a number of times, and then they just inflect a little bit. What do we do? In fact, that reminds me of something. Go ahead. Yes.
I mean, look, I think what you have to look at is, it reminds me of February 2020, where we were sitting at levels that were up and elevated. And, people forget that we hit an all-time high February 13th of 2020. To me, it was very obvious the market was a gigantic short at that point. But because the market operates as a carry trade, the guys sell vol and it just kind of floats up. And basically, you're having a couple days before that, you had like this mini vol event, and then it kind of recovered. And I would argue that you saw what happened last week, where there was like the 2% intraday reversal, and some of the zero DTE option sellers got, they felt some pain. That's what I could think. That's what I thought of right away. And then you had this little recovery, and now the CPI basically has ended the dreams and hopes of all the bond doves and
for today, for today. And by the way, I want to point something else out. I was just pulling up our friend Nadine Turman in my longbow. She has this thing she calls the Doomsday Dozen. That thing's only at 85 as of yesterday. So it's sort of, when you look at that kind of an indicator, which is a great greed-fear indicator, fear-greed indicator, and then you look at what's going on today, you try to foot the two of those. If you're looking at that, what do you think? How do you think of that? Because that's telling a very different story.
I would take it differently than that, actually. I would say that when you think about like something like the RSI or that Doomsday, when it hits 99 initially is not the time to short it, because there's so much strength. And you just think about like Newton's second law, the force is too strong. Now think about the stock market for the last month. Stock market's gone nowhere. It's been sideways. And you know what that means? Guys are selling. That means that there's not, let's take the example of NVIDIA 2 weeks ago announces a $100 billion project with Microsoft. In January or February, that would have sent the stock up 8-10%. It was flat that day, right? And so when you see that, it's like the opposite of when you get really bad news for a stock and it doesn't go down anymore. So I just think that the divergences are now going to where it's like supply has been hitting the market for a month, and there's like now people are starting to lose the narrative. So this is actually the time where you want to probably position to the short side.
Okay, thanks. This is great stuff. I want to bring in Berna Barchet. I know you're coming here to talk about something else. I'm going to put you on the spot, and you are not going to be happy with what I'm going to ask you. Okay? I'm sorry about that. I apologize in advance. But you were actually selling before this. I've got to ask you about that, given the theme of what we're talking about today. And then we'll get to what you want to talk about. But I'm just curious about what hit you in that direction.
Well, I've been listening to the macro chatter, but everything that I do is about the actual individual stocks. So last week I sold 5 stocks, a couple of things I exited completely, a couple of things I sold stocks that I love last week and then I'm super bullish on long term because of the price. So Ben just gave us a great macro analysis of everything that's going on, and I'm aware of the discussion about rates, the expectations around rates, and the disappointment that we might have about rates. But I don't spend a lot of time trying to game that. What I try to do is I try to figure out what are my stocks worth today based on their cash flow. So I'll tell you about the two stocks that I trimmed last week where I'm still totally bullish. And I only sold them because of price, and so that I can buy them when this happens. And if Ben's right and this keeps on going for a month and they're 20% lower, I'm gonna buy back the shares that I sold 10% higher last week. So, a stock, we could talk about it for an hour, but I exited Apple. I virtually exited Kura Sushi Bars, which is like a super overly expensive stock. But let's talk about the two that I trimmed that I loved. I sold some Netflix. I sold half my Netflix because I bought it at $187 and it was well over $600. It's only been a couple of years. It goes to that, bulls make money, bears make money, pigs get slaughtered cliche. But I remember I hated that stock at $600 the last time when we were working together. I talked about how it was a short up there. And then I realized, I'm like, oh my God, it's $600 again. Now the world's changed. It's making a lot more money. The competitive environment has moved in its favor, and its margins have done better than I expected when I hated it at $600 the last time. But it was no longer a cheap stock in any way. And no matter how well competitively positioned it was a competitively excellent, wonderfully run company that was just at a full valuation. So sell some, raise some cash. Similarly, I trimmed Crocs, which is a stock that I love that is only 10 PE. But it's been 7 PE before. So here's a stock that I think it's a company that has completely turned itself around. It's got 25% operating margins, positive sales, only 10 PE. I think it's going to grow. I think numbers are too low this year, barring a major economic collapse. But again, it's gone from 70 to 140. I'm going to sell some and have room to buy later. So, I'm kind of managing for the same thing that Ben's managing for, but I'm doing it on a very micro level.
That's great. And that's fantastic insight. I also don't want to let you out of here before we talk about, you're going to tell the truth about something. All right. That's a bad toss, but talk about Honest.
Okay, so this is Honest is a microcap CPG company that I spoke about before their earnings on the show in the beginning of March, and the stock made a move from, I think it was around 315 to 465 in a few days on earnings. So now, it's been, as Jeff was talking about, it's been terrible for small cap, retail consumer oriented stocks. This is CPG, but it trades more like a retailer because it's an immature company with limited profitability at this point. But I sort of made this call because I think they're at the beginning of a turnaround that's being led by an excellent executive who came in January of 2023 and has been doing a great job turning the company around. So now it's given back, it's down 10% today because of the surprise news last night that its founder, actress Jessica Alba, is stepping down as the chief creative officer. So the market hates management changes that are surprises. It's always attributed to being a bad thing when somebody leaves suddenly and unexpectedly. But I would say that in this case, this is actually good news. And there's for three reasons. One, when I initially did checks into this company with former employees, shortly after its 2021 IPO, one of the things that I heard was that the company did need new management. And I think that it's very natural in the life cycle of a startup for the company to outgrow the founder. We see this all the time in VC-backed companies that they have to bring in somebody else. And she had already moved down from being CEO, but to being chief creative officer. But a founder looms large within a company, especially when it's a famous person and an actress and one of the most beautiful women in the world and all this stuff, and I don't want to take away anything that she accomplished getting this company to where it is with 300 million in sales and the distribution and branding it has. But, at some point, sometimes founders become more of a hindrance than a help. And I think that was the situation here. So that's reason one, it's a good thing. Reason two, it's a good thing, is that where she is important, which is in the branding and marketing and PR, she's not going anywhere. She's staying on the board. She still has over $25 million in stock. She's incented to do what she needs to do to show up at events and otherwise hawk the brand, lend her image to it where it's going to help. I think an analogous situation is Weight Watchers stock recently crashed when Oprah left, but it's a very different situation because one, Oprah, this is not her legacy, right? Jessica Alba, this company is her legacy. She's going to care. And it's also a material amount of her net worth, which it is not for Oprah. So I think those, she'll be around when she's needed. And then finally, I think that it's a sign of confidence in the new management. Like she wouldn't have left if she didn't think the company was in good hands.
You see this as an opportunity, and that
I see this as a positive and not a negative.
This is another dip that you would buy.
Yeah, and it's hard to say, like, would the stock be down 10% if the market wasn't down so much today? I don't know, but clearly the market doesn't, the market doesn't like that she left.
All right, so I want to bring everybody in for the roundtable before we get out of here, and I want to go somewhere here, and I want to go to Ben, and I want to know. And this will be interesting to see where everybody fits in this thing. And that is, you were talking today, offline, you talked about how this is Christmas for you. This is everything you're positioned for. I want to know one thing though. Where does hubris potentially get in the way here? This is the issue with this market. You're feeling good. Things have come down. Where do you get a little jittery or a little nervous about it and wonder if you are sort of over your skis in terms of feeling good based on what's happening today?
I mean, I don't know, like nothing ever works forever. I mean, I don't anticipate interest rates to go to 10%. I mean, I just think that there'll be an unwind here of a lot of narratives and hopes and the market structures. I mean, and so it's going to take a minute. Like things don't just unwind, people are going to have to reposition now because think about it. So May and June are probably off the table now for cuts. I mean, they're the first cuts now being priced in November, which I still don't think will happen. But because you can't cut now into the election, and you really can't cut right after the election, so there's a political element to it. And so the only way that they could cut is if assets get crushed. So I would think that there's the asymmetry of risk assets are to the downside massively.
Well, but like Berna was doing, plenty of hedge funds over this past week, and even perhaps before that, were starting to unwind. We're starting to not unwind, sell their positions.
Yeah, definitely.
We're starting to. So they were seeing this, and now they were waiting for it. I don't know if it was it was just the obvious that people were watching what was going on with the rates. They were watching. Look, this was broadcast, right? This was broadcast a week ago when we realized the headlines were all about rates. Now, what's the chance this turns around and at some point we start talking about we're going into an election year. We have inflation this month. What happens next month?
I mean, look, one of the things I was going to talk about with gold is if you look at the ratio of gold or S&P to gold and oil over the last 100 years, it goes in cycles. And we've had three bubbles in that, 1968, 69, 1999, 2000, and 2021. So that's breaking. And these things last for 15 years.
Shouldn't gold be up today?
I mean, it's a momentum trade at this point. There's nothing goes up every day, when guys use leverage.
Today's an inflation number that should make gold go higher.
No, that's just a mental model you're using. That's not how it works. People use leverage, and when collateral gets destroyed, which happened today in a massive way, people have to de-lever. So, look at gold in the end of 2008. It was trading up right into it. Then you had the collateral destruction of the fall of 2008. Gold got torched, oil got torched, but they bounced back like that, and they made new highs within a year. So don't confuse the long-term trend with what's going on in market mechanics.
Okay, well, and market mechanics are what this market is this market and markets going forward are all about. Anybody else with anything here before we get out of here? Anybody else with a thought that they want to just add?
I mean, I would just say this is the time you should be making your shopping list. Figure out, it sounds like, ELF is on Jeff's. It's also on mine. It's a stock I feel like I missed. I'm being cautious, where I'm going to dip in, and I'm going to be more cautious on the ELFs just because I don't like buying really high multiple stocks when the stock market is a little shaky. I'd probably be more likely to buy back my Crocs or something that's a lower multiple as it comes down. But, that said, figure out the stocks that you want to own and do your work so you're ready when the opportunity hits.
Benjamin, you had another thought?
Yeah, I mean, I think in terms of that, I'm personally long a lot of Chinese stocks, and I was chatting with another member of our group, Russell, actually just a minute ago. We were looking at BYD, which is a Chinese EV company. I think that China's stock market trades at 9 times earnings. So, you can tell me all you want about how terrible it is, but it's 9 times earnings for the whole market, and it's the number 2 economy in the world. I think maybe
do you always believe the earnings? Do you believe the earnings?
I'm just telling you that I'm bullish on China.
Okay, listen, we could go on this because this is a great discussion. But unfortunately, or fortunately, depending on how you view this, that is it for today. Thanks for joining us at the Beats Roundtable. I am Herb Greenberg. See you tomorrow.